So if it wasn't bad enough in the restaurant industry, we just got a great Christmas present from the federal government for the restaurant business, and we're going to dive into that. And this is talking about the PPP loans and how you guys enacted those to save people's jobs and possibly your own businesses. We're going to dive into this and kind of dig into what this means now that they've started to move the 8 ball once again. My name is Paul Barron, and this is the Barron Report. All right, with me today, I've got Andrew Horowitz, a longtime friend and frequent show guest, an expert in money matters, and I thought, Andrew, let's just jump into it. Hey, welcome to the show today.
Thanks so much for having me. It's not a Christmas present, Paul. It's a bag. It's like a bag or a sock full of coal is what it is.
I like it. I don't like that, but it's a great metaphor. But the point is when you look at small business in general across the U.S., obviously the restaurant industry kind of falls into that category in a big way. Pre-pandemic, pre-crisis, this particular industry was sporting about 16 million people employed. Now we're under 10 million. We're potentially on our way to what could be a 50% reduction in workforce in the next 5 years if we don't get things stabilized. And now we get great news from the federal government that essentially the PPP money that you got that hopefully saved some jobs back in the summer is now essentially not deductible, and in a way, I guess you have to take this as income if you can't deduct those payroll expenses and the things you actually used to pay it for. What's the difference between this and a regular loan? If you take out a regular loan, don't you have to? I mean,
So that's interesting, actually. That's an interesting point that you make there, because a regular loan you have to pay back, right? It's not considered income. So it's not considered income, and then you just have to pay it back with interest over a time period, whatever it is, 2, 3, 4, 5 years, which may be a consideration for people that actually took this looking for the forgiveness as free money, but maybe now thinking about the next part, which is this, that while the PPP money that came in, is not a taxable event, especially if it's going to be forgiven. We're talking about the forgivable loan. However, the business expenses that were utilized for that through the PPP money that was infused into the company are not necessarily deductible. There may be a point where they have, remember that 60% of the business expenses have to be paid for employees, and part of it can be used for rent, et cetera. So there may be some area of that forgivable loan that may not in fact be taxable. But generally speaking, the planning process that we're utilizing right now as of the November 2020 IRS update is that pretty much the money that you got in from the PPP loan is and should be considered generally taxable, which is a problem, by the way. Here's the problem. Surprise. Not a lot of people thought it was going to be taxable. It's like, okay, I got a forgivable, I got a loan. It's going to be forgiven. It's like a grant. That's a non-taxable situation. I got $50,000. I got $100,000. I use that to pay for things like rent to make sure to keep things going during the lockdowns. I paid for employees, and all the money's gone. And now all of a sudden, you're going to have to pay, if you're in a subchapter S corporation, possibly pass that through because the expenses are no longer deductible. If you're a C corporation, for example, or a sole proprietor, it's going to have to be utilized as a block of new revenue. And therefore, $100,000, as a just example, could be $20,000 of taxes due. On that in 2021. Now, the guidelines talk about that if there is a reasonable expectation of those loans, of the PPP proceeds that are going to be forgivable, even if it's not forgiven in 2020, but if there's a reasonable expectation that it's forgivable in the future, then it is included in the tax base or is included in your 2020 numbers. So therefore, as they have been very slow to create the forms for the forgivable nature of the forgiveness, and it takes approximately 90 days for the SBA to come back with an approval. After usually a bank has about 60 days to process the forms. You're talking about somewhere in the neighborhood of about 4 or 5 months possibly.
That's at best
until you
case.
Get your final. Until you get the final approval. So therefore, you have to expect that unless something weird happened and you didn't use the money for those expenses, that is going to be forgiven. And especially if you're a small business under, let's say, $100,000, $150,000, those are going to be easier to probably just get through the system. but you're going to probably have some taxes due on your 2021, which is due by April, depending on what your tax structure is, which is going to be more of a hardship.
Yep.
Because a lot of people didn't put that aside.
Well, yeah, and that's my point. I think when you look at the restaurant industry, we already have, it's a very interesting perfect storm that is brewing right now. I talked to Andrew Zimmern about this, and
Love him.
I keep referring to a comment he made that just shocked me a few episodes ago on the show. We'll put the link to that episode up in the corner. But the point he was making was that if we don't get the stimulus for the restaurant industry, he is essentially saying we're talking extinction level event. And when I say extinction level, we're talking 80% of the industry. Now, you have to realize we've already had almost 30% of the industry has either, they've closed or have made the potential of they've gone out of business. They may restart under a new entity or something of that nature. But with this kind of scenario, you take a brand that, let's just say independents, which are the ones that get hit the hardest, and they're doing $2 or $3 million in their restaurant, high volume independent, nice fine dining restaurant. He owns 2 or 3 units. I mean, his PPP money was probably in the $250,000 to $300,000 range, maybe even greater. So what is it to stop? I mean, to me, it just seems like this is going to push a lot of companies either into insolvency or bankruptcy, or just simply shutting their doors and saying, well, we're done.
I don't know what is going to be the next stimulus that's going to be coming available. There is a discussion about new PPP programs that will come out, and the PPP programs will be targeted for people that are taking a major hit compared to, let's say, last year or whatever period they're going to compare it to. So that may be a help, and I think there will be something eventually that will come. I mean, the restaurant industry is going to be suffering much beyond that. There's just so much of a hole that you can plug in a sinking ship. And I say that with, unfortunately, because really, what is it all about? It's all about the fact that the virus, the pandemic, the idea that people are concerned about going out, even if there's a vaccine for emergency use authorization that's approved, it's still going to take, let's say, 6 months to get the next level of immunity out there. And we're entering into one of the times of the year that was very good for restaurants, right? This is holiday season, into the end of December. The problem is that the industry, and you kind of spread this out into the travel and leisure industry in its entirety, you got to really rethink how long are you willing to hold on with what you have right now, because is it ever going to go back to quote unquote normal in a period of time that you can then not have stacks and stacks of loans that you took out in order to live on, what may not be the same level of volume or capacity in your restaurant.
Right.
I don't have an answer, by the way. Well, I don't have an answer.
Yeah, and I think the scenario is that even if we get the stimulus that comes through, if it comes through, the big problem I think we're going to be faced with is operators that either, like to your point, is they can't hold on. Now they've just been dealt a new tax bill that's coming due in April that they didn't prepare for, and in essence probably are already struggling just to keep kind of the lights on kind of scenario and waiting for potentially. So, I mean, it feels like it's almost going to be good money after bad. When the stimulus comes through, it's possibly going to be used to pay off your tax bill of your PPP money that you haven't got even forgiven yet, which who knows if they continue to change the rules on the PPP money, because I think we're going to continuously see more and more regulation around whether or not you even get it. I just feel like we already have a lot of restaurants that are on the fence. And this likely could be as many as another 100 to 150,000 restaurants on the fence for closure, which would be an absolute devastating issue for the industry, because the independents are the ones taking kind of the heat in the fire right now.
Well, here's another problem. If you think about the timing of the last PPP when it came out, right? So at that time, think of where we were from a standpoint of expectations. Back then, we're like, okay, we have this really bad pandemic and it's really horrible, and we're going to shut down the country and we're going to shut down restaurants, and then we're going to reopen. And then slowly but surely, the pandemic is going to go away. We expected the pandemic to go away by this summer, right? That was kind of like, so you know what? if I could hold out, well, it was supposed to be Easter first. That's what we were told. But nonetheless, that was highly ridiculous. So we thought, okay, maybe by the summer, warmer weather, people are gonna, it's gonna calm down, and we weren't gonna see as much of the spread. And if I took PPP money as a an owner of a small business, a restaurant, that could get me through.
Yeah.
Right. That was the whole idea of it. Like, get me through. I can have my employees that I don't want to let go, and I feel terrible about it. I don't want to have to let my restaurant go because of rent. And you know what? I don't have to pay for things. If we're not opening the doors, I don't have to pay for food. I don't have to pay for maybe utilities to a degree. But yet I don't want to have to let my employees go, and I need some extra money, especially to pay myself.
Right.
And that was supposed to last until the summer.
Right.
And then all of a sudden, this is like ongoing forever. So the question would be is, how much uptake will there be on the next stimulus program if in fact there are a lot of questions as to how long is this going to last for?
Yeah.
If we get this vaccine, the miraculous vaccine, everybody takes it, it's still not going to be able to be distributed till when? I don't know, April, May, June of this coming year, and there's still going to be a hesitancy for people to come into restaurants. So it's and this is the season for a lot of places cold, and you can't have outdoor seating. Mm-hmm. So it's a real predicament.
Yeah, and this is going to be and I think a lot of, and just for our viewers and listeners, when you look at the restaurant industry, crisis, about 80% of the industry are independents. And when I say independents, they're non-chain. It's your mom and pops. It's your, fine dining restaurants that most of you probably go to. It's usually your top 25 restaurants in any given city, even like here in Miami. Those are all independent chefs. Sure, there might be someone like a Grove Hospitality Group that has 5 or 6 restaurants with celebrity chefs or something like that. But even them are being essentially dismantled as we speak. Yep. I see more and more chefs that are basically just closing their doors and just have no option to go. Now, and a segue to this is a flip over into the chain side of things. And now it's a different turn of the page. And I want to review with you some stocks. Okay, so let's break into our first stock discussion, and that is Chipotle. All right, so you obviously saw the recent upgrade on this by Piper Sandler, who basically have put this stock at pretty much an untouchable, what I think is an untouchable stock price for restaurant stock. What are your thoughts on Chipotle's current situation, and do you think they can hold this to continue to see some growth?
So just to put an underline of what we're talking about here when it comes to the differential between what you mentioned, which was the fine dining establishments and the independents, and now flipping over into the area of these, nationwide, well, global to a degree, nationwide chains, we'll call them. The difference is it's a very important differential. One is the number of locations, which is also a lot of problems can be with that, during lockdowns and stay-at-home orders and pandemics. However, they have a secret weapon, and that is technology. If you have a chef that's making, handcraft, you go to the bar, they're making handcrafted drinks, and they're changing up the menu daily and doing all that, but you really have to be in-house for the experience, right? Right. Whereas if you have a Chipotle, and I put like a Domino's in that same category, and even a McDonald's to that degree, but really Domino's and Chipotle, they have really leaned heavily on technology. And that's where the magic sauce is with regard to what they're doing. Because they can figure out exactly what restaurants require, what ingredients, how much to order at any given time, spoilage, they're watching this stuff constantly, right? And then they can do things like have outside sources like an Uber or a delivery dudes or a DoorDash, whatever it is, delivering their foods and almost creating a different restaurant experience. So the fast food and the fast casual can do something much different than the independent operators, the fine chefs, the quality restaurants can do from a food standpoint. And Chipotle definitely has some room to run on. We're seeing that EPS and revenues are expected to increase and accelerate into 2021. And I think it's all based on the technology that they're utilizing and whereas an executive chef in a hotel may go in with a pad of paper into the walk-in fridge, right? And what he's going to do is he's going to look around. He's going to, I need another block of cheese. We can get 2 dozen eggs. They're looking at what they have. Oh, we have a holiday weekend coming aboard. Hey, let's get some more bread. Let's do this, whatever they're doing, right? The equivalent of the executive chef of what they're doing with the ordering process in a restaurant is computers in Chipotle.
Yeah.
And that's changing the whole dynamic of margin, profitability, and expectation into the future. It's kind of an AI-enabled ordering system, pricing system, and constantly be able to maneuver to tweak out the best profitability.
Yeah, and okay, so just to be fair, my history of being a bear on Chipotle, it has to be, you have to look back at the period in which I was analyzing the stock and saw a lot of problems in their consumer sentiment. And this is I'm going to say all the way back to summer of last year, where they were still having some remnant problems of their E. coli issue. My point is, with Brian Niccol taking the helm, he kind of restructured the brand from a digital standpoint. Obviously, their big news which I think has taken the stock up again, and possibly even influenced Piper Sandler to move this thing from a $1,514 to a $1,745.
17.
Yeah, that's crazy.
Right.
So now, and listen, I am not necessarily, a bear on Chipotle. I am now back in the camp of looking at this brand a little differently, mainly because they have taken the initiative of moving much more aggressively in the digital front. Obviously, they have won the digital sales, and I think everybody is kind of following around them right now. All right, so Chipotle,
and by the way, don't forget they have a lot of activist investors like Ackman and a few others that have been really working hard at changing this and streamlining it and doing whatever they can to tweak out all the profitability possible. So that's something.
I foresee that Chipotle is probably going to be a brand that moves very heavily into the digital space, the ghost kitchens, goes into a delivery.
Absolutely.
And most likely continues to ramp up their own delivery. They're still killing it in terms of delivery. It's not even worth going into the store anymore. I have found their delivery is just superior when you look at the rest. All right, so let's jump over to Shake Shack. And Randy Garutti, he's talking about digital upgrades fueling their expansion plans. The last time I had Randy on the show here, he kind of alluded to the point that they may kind of shift away from some of these urban centers. And obviously, we know Shake Shack here in South Florida. They're right up here in Boca Raton, Florida. That's not an urban center. That store is doing phenomenal. What are your thoughts on Shake Shack's current situation? They've kind of flatlined here.
So I've never been a big fan of Shake Shack. Listen, their hamburgers are okay, extraordinarily overpriced for what they are, in my opinion. Their revenues are going to be going up. It looks like they have the consistency, but their earnings are going down. I think there's a high cost in what they're doing. They have a high margin or a low margin product, generally speaking, because of some of the quality they're using, but also, as you mentioned, some of the storefronts that they have in some of the expensive areas. Obviously, they're getting their butt kicked in many of the metropolis areas where there was a walk-through business for a while. Exactly, is where they started, right? In a little park, in fact. And so, I mean, it's burgers. It's burgers. It's custom artisanal burgers. I mean, they're everywhere. 5 napkins, and you name all of them. I don't know. It doesn't make sense to be valued at the level they're valued when you have revenues that are going up and they're projected to go up, but yet still earnings are going to be going down, and it doesn't look really good on a chart. From the earnings and revenue fundamentals, chart looks great. It's trading at what, $82, $83 a share. I mean, it's a extreme high of where it was. I just don't get it. I don't get it.
Yeah, and we kind of track consumer sentiment along with these. It's our analysis just to kind of see what the pulse of what consumers are saying. If you look back at Chipotle, consumer sentiment, I looked back at their data this morning. Consumer sentiment has been on a steady rise, and once they really started accelerating in the digital front, their consumer sentiment has continued to rise because they haven't screwed up, that issue. Versus if you take a look at Uber and their consumer sentiment is absolutely terrible. But if you look at Shake Shack, their consumer sentiment has actually started to take a decline. Now, part of that, I think, is their own Achilles heel. part of the Shake Shack experience was going into the store. It was going into that cool, hip vibe, and there was something there. You know, Chipotle sure is a cool, hip vibe, but listen, it's just a burrito chain that you walk through and, you know, they throw some stuff onto a taco bowl. The experience just isn't the same. Yeah. But with a Shake Shack, it feels differently, and I think they're hurting from a consumer sentiment standpoint. And to your point, I don't know if customers are going to continue to go ahead and pay that premium. So I think we're going to see a stock fall on this one, for sure.
I've always been on the short side of Shake Shack, to be honest with you. Not short right now, but we've always leaned that way.
Yeah, I think we might see a little bit of a down movement unless something changes dramatically for them on a big announcement. Like if they come out with, you know, a whole series of ghost kitchens or things like that, that would change.
You know, you keep mentioning ghost kitchens. Can I just talk about something that's really interesting for a moment on the idea of ghost kitchens? Because the ghost kitchens, you know, you think about the fact that somebody's opened up a big warehouse somewhere, throwing in, you know, no windows, right? Just have people creating whatever the delivery item is. So one of the trends right now, you've probably been following this, is we have side doors. Which is a restaurant rebrands. And I sent you a couple of names of this, and I have a friend that recently did this with a major chain. They basically rebrand. You don't know exactly what it actually is. So let's say it's a burger chain. Let's say it's even Shake Shack. And they, instead of calling it Shake Shack, they call it Shack Shake. I don't know, something, you know, shaken burger. You don't know it's actually them. It's only available on delivery. And what happens is they don't need to expand, pay anything extra at all. They can have an abbreviated menu only for delivery. You wouldn't know where this stuff came from, if it came from there or not. And what they do is they put their highest margin products on that delivery platform, and they just do it side door, out of the back door of the restaurant, delivery style, utilizing all the same equipment, all the same staff, all the same products, all the same supplies, everything. And it's been working pretty interesting for companies like Chili's, was one of the ones that did that. There's Anthony's Coal Fire Pizza down here. They changed the name, changed the look. Basically the same exact menu.
Well, Pronto, when you talk about Anthony's, who is a well-known pizza chain based here in Florida, but they, you know, Pronto, I know Nick Castaldo, who started that concept, and they did it well before the crisis. And they were successful with it, but as a takeout-only product, and that's done, you know, it's done some unique things, which essentially is what you're referring to as called a virtual brand. We are seeing big movement in the space. Most of the time, it's, you know, Smoky Bones also based here. They've already spun off 3 or 4 different concepts. You know, Doghouse and Andre over there. He's spun out, I think, 6 or 7 brands. We're going to continue to see that kind of occur. And I think back to your whole original premise on Chipotle, is technology is the driver here. And if you can target and you are doing a good enough job at getting your customers happy, especially in this era, which continues to be, you know, takeout, curbside, all that, we're going to see some pretty interesting data as we move forward. Let's jump to Darden, because this is another one that just went kind of flatline on us. We saw a downgrade with Darden, and I'm kind of in the same camp as the current analyst on this, as we see consumer sentiment start to fall with that brand. Again, Olive Garden, their flagship, is one that is kind of leans toward the experience. And if you lose that, what do you have? Your thoughts on that?
Well, a couple things. Darden, we are seeing clearly that revenues have not reached pre-pandemic levels at this point. Doesn't expect it to be there until about 2022, if I can push my expectations out a little bit from where we're seeing analysts come in on this. There's no earnings growth in the company either. So even before all of this, it was kind of flatlined to begin with, and it's just nothing. I mean, what do you get when you go to an Olive Garden? Aside from the salad, I personally can't eat anything there. I just can't. That's me. Sorry. But when you go to these restaurants, you know, what are you actually getting? Well, you're getting a cheap meal, and you're getting, you know, kind of, okay, I'm not even talking about service. You get great service, I'm sure. But what are you getting? You're getting family style or family friendly kind of meals that are just like, okay, let's go to the Olive Garden. It's quick. I know the menu. We'll get it. You know, it's cheap, and we're done. Right now, with the advent of back to technology again, you don't have to go to the Darden for that. You can get that kind of, or the Olive Garden. You can get that anywhere. And if you're not going to have the experience anyway, you might as well get better food. I'm just saying. So you might as well order from somewhere else. Frankie Meatballs down the block. Grab it from him. Have it delivered. You got Italian food right on your table, and it's good stuff. So I'm not really a big fan of Darden and their the underlying companies.
Yeah. So when you look, and yes, I would agree with you that Darden has a little bit of an identity problem because they just weren't prepared for the whole aspect of takeaway food. But here's my I guess my theory, but also my recommendation to operators out there, even in the chain business. And I know it's difficult to move quickly because you're steering in most cases, a small Titanic with a brand like Olive Garden and what Darden's doing with all their concepts. But I think they've got to move. If they have not already moved dramatically to digital, many chains, and I still talk to CEOs all the time, are waiting this out. They're doing just enough to kind of get by, to kind of deal with the situation, but they truly believe we're going to see the return to normal. And my whole feeling on this is, guys, I don't think so. And I don't think 2021 you can set on the sidelines. This is your year to reshift and unfortunately, it's going to change the landscape of their business model because real estate's going to come into play, all these kind of things.
Right. Doesn't Darden also have a lot of their anchoring with regard to major shopping centers and malls? So that flow through traffic is the equivalent of what we talked about in the major cities. It's just not there.
It's just not there. And it's the same scenario with fast casuals who've been building out in the urban centers and now have tried to, and many of those CEOs are still talking about, trying to build out in the urban centers. It's coming back. And I just feel like we are seeing, I hate to use the word reset, but I think we are seeing a massive reset in the industry. And I'm not sure that the industry is truly all in on what needs to take place in the next 5 years. Because right now, it's a 5-year plan that I think is probably going to be much more aggressive than any CEO, with the exception of a handful that I've talked to, are ready for. And because in many cases, these guys, listen, the restaurant industry prior to this crisis moved like dinosaurs. They know it. I'm not telling anybody anything new. They all know it. And I think now they've got to really kind of get into, as they say in the world of Tesla, into cheetah mode. And and have to kick it up. All right, a couple more topics here. One is Pizza Hut and Domino's now going head to head. Pizza Hut struggling a little bit. They've got outpaced by Domino's in terms of franchise growth. Obviously, Pizza Hut had a huge problem with their biggest franchisee going into insolvency. What are your thoughts on Pizza Hut? Because that's a huge crown jewel of the Yum empire.
I mean, if you give me a choice between a Pizza Hut or a Domino's, not from the aspect of the food, but the aspect of the concept of which one will do better, it's got to be Domino's. Domino's was, I mean, think about it. Domino's was, even back in the day when it was 30 minutes or less. Remember that? When there wasn't technology, when you called up and you're like, I want this, and you get your pizzas within 30 minutes or less. That was their big thing. That was technology at its finest back in the 80s. And when you look at where we are today, I mean, they decided, you know what, we can really do a great job. I mean, so they're a logistics firm, they're a transportation firm. They kind of set the stage for Uber Eats, if you think about it, right? They're the ones that really created this platform of delivery, utilizing drivers and handling all of the process of timing of when we're going to go, where we're going to go, routing and all that. So I would say that a Domino's is definitely a cleaner pick than Yum. Yum, solid trend though. You know, the stock itself is revenues are near.
KFC is kind of making some moves that kind of helps them, I think. Yeah, for sure.
Big in China, very big in China, and Asia for that matter. They love fried chicken in Asia. They love Kentucky Fried Chicken there. Cost factors could be an issue because the net income is down a little bit on that. But, you know, generally speaking, it's a solid trend for them. And if in fact, if we can think about that, there is a lot better trend for the pandemic, if we can believe the information that's being presented in Asia. I mean, Japan had as many deaths total that we had yesterday. So, you know, if we could believe the trends and all that, Yum definitely has Yum Asia, that component, doing very well for them.
For sure. All right, here's a company that is, I believe, kind of a gem in the rough. They haven't been able to completely pull it together. They had an amazing midsummer, late summer run, and that was Wingstop, who just went off the chart. And then we've seen kind of a normalization of that brand. They were listed on one of the 8 stocks to sell after the election, which I thought was very interesting, because we're going to continue to see, even though their CEO has gone on record on many of the shows, whether it's CNBC or NBC, MSNBC, on that they're going after growth. They're actually going to go in and start opening up in neighborhoods. Now, they've always been a suburban brand, which I felt was a strength for them, because they were in the places where people were moving. They still had a product. What I think has hurt them this fall is the sports industry. I think we have seen such a fall off in the sports business, which wings and football are the thing. And we've seen a fall off on Wingstop. Do you feel like this brand was overinflated and just kind of normalized and might be a potential buy here in the next few months? What are your thoughts?
So I think it's a good company, but I think also what happened here was the equivalency of football. I got to have some wings. I got to have some greasy food. I don't care. Was the equivalent of, man, this stay-at-home order, this pandemic, this unknown, I need wings, I need greasy food, I need stuff to stuff my face. And I think what happened was that everybody was thinking of, what can I get delivery? Well, we know we can get pizza delivery. We know that. We know that Uber Eats has all this stuff too, but it's like, wings are easy, they're inexpensive relatively. So let's get a mess of those and we can feed the whole family. I think wings were kind of like the hero of the pandemic. And I think that it translated into very significant, a positive attitude towards the stock. We saw the stock just go crazy. It was like, what's happening with this stock? Why is that? Till you start to realize what was going on. Post-pandemic, people may be thinking about, maybe I don't want to, maybe I got to get back in shape. I put on 15 during the pandemic, and I've been trying, I just lost 10 over the last couple of 3 weeks. I'm going back to my exercise routines. I'm going back to eating well. And kind of changing the habits. I think that's going to be a big issue. Back then, it was like, okay, I'm going to eat the wings. Hey, I'm doing a half hour on the Peloton. Hey, order the wings again. Right now, it's kind of, I think, you know what? Why don't we get some, some Beyond Meat burgers, something healthy. Well, they're not that healthy, but some other healthy type of food, and we'll continue on with our exercise program. So I think, and maybe even go to the gym. So I'm not the biggest fan of the. If the gym is open. I'm not the total fan of Wingstop from the potential for like taking over the world. It's a little bit different than a Chipotle or a Domino's. Wings they're messy. They're a different breed of food. And I don't know if the growth is going to enable them to do the skyrocket that we saw, that vertical parabolic move throughout the summertime. In the future.
Well, definitely.
But not a bad stock. Nothing wrong with it.
Their numbers, I was just looking at this, late July, they spike up to a little over 170 a share, which that run went all the way through almost into September, which was pretty impressive. And then, of course, we've seen the stock slide down to what was our open today as of this recording at $126 a share. Which is a massive move, and I do think it was a normalized. I think that was just kind of what you mentioned was a reaction, summertime. But sports has definitely hurt this brand. The football in general has been just decimated across, whether it's college or pro, whichever you look at. All of the concepts that have kind of built around that have been struggling. So there's definitely some interesting. All right, so Andrew, these are great reviews. I love to kind of talk this business with you. I think when you look at the restaurant industry, there's just so much going on in the space right now for investors, for companies who are trying to get their business kind of on the next level, whether, and of course, Chipotle has kind of become the star child again. But it's going to be an interesting first quarter, I think, as we jump into 2021. Last question for you. If you're looking at whether you're a business owner or these big brand guys, when you look at what's happening from an investor standpoint and what investors are looking for, because I think most people are saying, well, hey, we want high yield, we want this, but I think forecast is the biggest thing, or at least the opportunity that these CEOs have enough forethought that are moving their brands forward. And this happens across the industry, doesn't necessarily have to be just food. What are your thoughts on what is it that a CEO needs to do today to really kind of lure that investor in?
I mean, I think you have to have a good balance sheet, which a lot of people are doing because they could fix their balance sheets through low-cost borrowing if they can change over what their current debt structure is. I think good cash on the books as well is really important because a lot of people are still shell-shocked. You know, we have this PTSD, this post-virus stress disorder that is, while it may not be here for the next 100 years after this, there's still this reverberation about, oh my, what happens if? And there's always that happens over a few years after a major event. So I think a clean balance sheet is a big issue. Talking about growth, talking about the question about what happens if we do have inflationary pressures, how are you going to hedge out? Or how are you going to deal with this to keep your margins growing? We look at margin expansion as something really important. I think that CEOs should look at that as well. But I think that, you know, it's all about lean and mean.
I'm with you.
That's the issue right now.
I'm with you.
That's what it's all about, lean and mean.
I like that. That's a great tip for the industry right now. I think that's, and even though when you say lean and mean, a lot of the industry, that means layoffs. And unfortunately, I think we are going to see another big round of those, even after you know, the first quarter of next year. Andrew, it's always great talking to you. Thanks so much for jumping in on today's Barron Report. It's been amazing as usual. We're going to stay tight as Q1 rolls around for 2021.
Great. Thanks for having me. Be well. Thanks. Happy New Year.
All right. So you guys listening in over on the podcast or you're checking this out on YouTube, we've got a lot of new content coming out before the end of the year. And we've got some new stuff that I think you guys are going to really love here on the network, especially if you're into kind of the educational format, especially with some of our events. And of course, check out some of our other shows, Fast Casual Nation, the podcast, and also our Rising show, which is a pure podcast, and that is Takeout Delivery. And the catering show, you can search that on Spotify or on iTunes or wherever your favorite podcast app is. Just jump in there. If you have an idea for a show, shoot it to me at Paul, or actually shoot it to our producer@foodabletv.com. I almost gave you my email address. And I don't want to do that, but you can hit me up on Twitter by just hitting me up at Paul Barron on Twitter, and I'll be glad to, you know, kind of have some conversations with you there. DMs are fine, but if you have a show idea, hit producer. Thanks again for stopping in on to another Barron Report. We'll catch you next time.